Hello, everyone. This is Paul Sundin. We're just about ready to kick things off. I got a couple people here that are going to be joining momentarily, so let's give it another 30 seconds or so before we jump in and kick this thing off. All right. A little bit of an intro here. Make sure you see on the right side there's a chat. If you want to have any questions, make sure you post them there. There's actually also some handouts. There's the slides relating to this the webinar. So you've got the slides right there. So you're always welcome to download those as you see fit, and take a read through them, and then let me know using the chat function if you have any questions or anything like that as we go through everything. Okay. Again, this is more of our intro webinars where we talk about some of the basics of the plans and walk through. Usually we take about a half hour, sometimes a little less. I think we'll run a little less on this one, probably closer to 20 minutes or so, but certainly give you guys a chance to ask some questions. We always cover a little bit of a special topic on each one. And the special topic today, we talk a little bit about some of the pricing and some of the fees that you'll see out there, why the plans are expensive and how they're priced, just to give people an idea as they're shopping around here as we get into the busy season. So that being said, let's just jump in. So obviously, my name is Paul Sundin. I'm the president of Empyrean. Been doing cash balance plans for about 10, 15 years with a lot of my CPA clients. We'll do this is an overview here where we'll talk a little bit about an introduction about the plans. We'll talk specifically about what a cash balance plan is, talk a little bit about the pros and cons, who a good candidate is, and also review some of the strategies that we use when we're trying to maximize a plan. Again, we'll have our special topic where we'll talk a little bit about pricing and fees, and then of course a Q&A there in the end. As I go through, if you've got a question along the way, you are more than welcome to fire off the question, and I will, if I'm on that subject, I'll try and do everything I can to answer it. If not, we'll do some Q&A in the end. Okay. Intro again, a little bit about myself. CPA for 30 plus years. Do a lot of retirement structuring, comprehensive tax planning, entity structure. I am the president of the company, of course. What we do is we do again, mostly retirement structuring, including cash balance plans and defined benefit plans. We also get involved in other types of plans from time to time, be it Section 105 plans, of course, basic self-directed 401ks, mega backdoor, Roths, things of that nature. We're involved in third-party administration and compliance, obviously, so we are a TPA with these plans, but being that we're kind of born of a tax firm, we have a little bit more of a tax focus. We're not financial advisors and don't do tax returns, but obviously our goal is to make sure we educate the clients on some of the strategies that we use that aren't really understood or implemented by a lot of CPAs. In fact, most CPAs, probably 90% of CPAs and financial advisors actually don't understand how these plans work. We also, our main goal is to lower your tax bill and make sure we grow the retirement. But typically the number one reason people do these plans is for tax purposes. So that's always pretty critical. What is a cash balance plan? So we'll talk a little bit about some of the basics. It's an IRS approved plan. It is a type of defined benefit plan. Again, there's two main types of retirement plans. We'll talk a little bit about them: defined benefit plans and defined contribution plans. But defined benefit plan promises a specific benefit at retirement as opposed to having an annual limit, much like a 401k would. They're actuarially determined and they're reviewed annually. So you have to have an actuary review and sign off on the plans. And again, typical contributions, these plans are over 100,000. Generally speaking, what we find is that most of our clients are doing, 150,000 plus or so with these plans. So great planning structure if you're looking to get large amounts into retirement. Defined benefit plan versus the defined contribution plan. Again, we talked a little bit about this, but a 401k is the most popular defined contribution plan. Most people have heard of a defined benefit plan, but they really don't know they really don't understand necessarily how a defined benefit, or what they'll call a DB plan, works. But a defined contribution plan, again, establishes a limit up front. Once you hit that limit, it does not matter whether your assets go up or down, because the limit is established up front. Whereas with a defined benefit plan, we can get in up to 3.1 million. In fact, it was indexed to about 3.4 million for 2023 for next year. But we can get in approximately $3 million. And because those limits are so high, you can make much larger contributions as you sort of march towards that goal. So it's not unusual for someone who's maybe 65 years of age to be able to get $300,000 a year into a plan. A younger person, mid-30s, might only be able to get 100,000 or so in, because the plans are very much driven by age and compensation. But again, very large contribution limits, and allow you to get much larger amounts in, because we're defining this benefit at retirement, which is different from defining a specific contribution in a given year. Nice thing to note is these plans can be combined. At least a 401k can be combined. There are limitations on profit sharing. Profit sharing is limited to 6%. But definitely, if you've got a 401k, you can layer a defined benefit plan on top of this and use the two plans in conjunction. Again, there's certain rules and restrictions, and we walk through that with all of our clients when we set up a new plan. Why do people set up plans? Again, I mentioned this. Number one reason is for tax deferral. Our average client's probably $500,000-$600,000 a year. Overall tax bracket 40% or so. Again, if you can put an extra $100,000 in retirement, that's probably going to save you about 40 grand. Not only is it tax deduction up front, but it grows tax deferred. It's a great way for business owners to catch up on retirement. And once you're done with the plan, you have to have long-term intent with the plan. The plan can be terminated and then rolled over into an IRA. Also, you've got some flexibility in contributions. You can contribute up to the date the return is, the tax return is filed, which is the latest date being September 15th. Actually, if you're a sole proprietor, your deadline might be October 15th, but you still have to get your plan funded by September 15th for the prior year. So for 2022, you have all the way up to September 15th of next year in order to make a contribution. And again, they're not just for large businesses. Typically these plans, they're kind of like Social Security in that you get they're set up to provide you a monthly payment. But the reality is these were always used by large companies, then they went away from them because of the uncertainty of the contribution. So most of the plans we do today are for smaller businesses, 0 to 20 employees, for example. Moving on, pros and cons. Pros, of course, able to contribute much larger amounts. Our average contribution is 150, whereas if you've got a 401k, you're typically limited to $20,000 to $40,000 a year. So it's just not going to get you that far if you've got a high income. Again, you can combine them with the 401k. You can also roll them over into an IRA or even another 401k or qualified plan once you're done with it. And you do get funding flexibility. You're not locked into a set amount. Let's say you do 100 grand in your first year. It's not like you have to do 100 grand. We can structure a plan like that. But it's not like you have to do $100,000 every year. We provide you a funding range where maybe you can do 75 in a poor year, 200 in a better year. You get a range to pick and choose. So they do allow you some funding flexibility. Of course, the big con is they're more expensive to maintain. We're going to talk a little bit about the pricing and the fee structures. They are also permanent plans in nature. Doesn't mean you have to have them forever, but you want to have them for at least several years. The IRS has said several years. They haven't exactly said what several means. Some people say 3, some people say 5. I would say, go into it with long-term intent. If your situation changes after a few years, then obviously you can terminate and roll the plan over. Just think of it as a long-term existing plan that you have to fund. Again, there's mandatory contributions with these plans. And of course, they're a little bit more complex to explain and administer, a few more hoops to jump through with the complexity. But obviously, if you can handle the cons, obviously the upsides are pretty huge for a lot of people. Next slide here, best candidates. First of all, companies with consistent profits, because they're permanent plans. We like to see people who want to make, who have the ability to make annual consistent contributions. This includes professional service businesses, doctors, lawyers, CPAs, business owners, obviously owners trying to catch up on retirement savings. Sometimes we'll have an owner that maybe doesn't make ideally the perfect amount of income, maybe $200,000 to $300,000, but maybe they're 55 years old and they have very limited retirement funds. Great opportunity for them to catch up and make some large contributions. Also, owners looking to maximize the tax deductions. Again, they might only make $200,000 to $300,000 a year, but they might be married to a spouse that makes $500,000 to $600,000 a year. So obviously, those, they're in a very high tax bracket. So those lower, even though they're lower income, still those contributions might be able to save them more than 40%. And obviously, they do help people who have employees and are looking to improve morale and employee retention. A lot of people use them for employees as kind of a bonus plan for them and a bonus structure. So that helps out a lot. We're going to take a quick look at a few of these funding examples here that we've done, just so you can get an idea. Now, these are not meant to go over, minimums, maximums. They're really just some examples of a few different ways we've structured some plans. Obviously, if you have interest in finding out a little bit more about or having us structure a plan, we're glad to chat with you, and you can reach out to us. We'll talk about that in the end. But these are just kind of give you a little idea into how these things will work here. So first example, 35-year-old IT consultant. We're going to assume these are all S-Corp structures. W-2 compensation of $200,000 with a business profit of $150,000. That would be about $350,000 of total income. Contributions to the plan, 401k contributions, $20,500. Profit sharing is limited to $12,000 with this plan. And the way how we get the $12,000, it's actually 6% of the W-2 compensation. So it's 6% of the $200,000. So that's going to be $12,000. Cash balance plan contribution of just over $98,000. Total retirement, $130,000 with a 40% tax savings of $52,000. I mean, you can see on $350,000 in income, clients getting whatever the math is, 35-40% into retirement. Not a bad deal. Next example, a little bit older physician, 58 years old, same W-2, 200, business profit of 400, total income 600. Deferral is an extra $6,500 because this physician is over 50. Profit sharing still 6% of the 200,000, so that's still your 12. In this example, 58-year-old gets $212,000 into the plan with a total contribution of just over $250,000, tax savings of $100,000 in year one. The last example is a little bit more unique in that it's a 65-year-old attorney, and this happens a couple times a year when we have an attorney who comes to us who's really looking to maximize a plan, and they've had a settlement. Typically, sometimes they'll do a structured settlement, but they've come to us and they've got $2 million of income because they're part of a settlement, and so they're really looking to shelter as much as possible. Well, in this example, they would get their W-2 to the highest at $305,000. That's the highest for IRS purposes. The deferral of 401k, again, over 50, $27,000. Profit sharing, 6% of the 305 or $18,003. And the cash balance plan contributions just over $500,000, 502, to give you just under $550,000. And how we get that 502 so high is we can do what's called a couple tricks called prior service, where we can give you a credit for a current year. So we give you a credit in the current year for prior years, okay? And so that actually works out very well. That's the way to really get a big contribution in year one. And again, a tax savings of $219,000. So again, just a few examples of how we've structured these things. Couple strategies we use if people are looking to get more into plans, include a spouse, consider paying yourself a higher wage. You can exclude 60% of eligible employees with these plans, so you don't have to contribute to all your employees if you have some. You do have to provide them with a meaningful benefit, typically a few percent of their wage. We have discussed that you could combine these plans with 401k, profit sharing plans. You also can hire part-time employees. People who make less than 1,000 hours, or excuse me, work less than 1,000 hours, are not required to get an allocation to the plan. Also, people under the age of 21. You can also consider hiring contractors, using 3-year vesting, life insurance. The list goes on and on. Section 199 is QBID, has to do with the 20% pass-through QBID deduction for business owners. These plans are fully eligible for that. So not only might you save 40% federal and state, they also give you the ability to pick up that 20% deduction, which is so critical to many. And also they give you the option to, like I had said earlier, give you a funding range where you might be able to go, for example, 75 on the low end to 200 on the high end. Because that range is so wide, if you've had a good year, you could fund at the very high end, the 200, and then maybe fall back to 100 or so in the following year. So some very flexible ways that you can structure these plans to make sure that they work for you. Deadlines. Deadline to set up the plan is the due date of the tax return, with the latest date being September 15th. So you do have up to next year to set up a plan. However, W-2s, most of our clients are S Corps. W-2s have to be finalized by December 31st. There's a lot of people who are making contributions to 401k plans, doing profit sharing. There's limitations. There's also tax planning that goes on with CPAs. Moral of the story, we tell everybody, make sure you do your due diligence so that you can do these as quick as possible by the end of the year. We tell most clients to try to make a decision by December 1st so that they can cross all their T's and dot all their I's to make sure W-2s are taken care of, all these other things before the year is up. Okay. So again, you have plenty of time. You have 10, 11 months or so. But I think for most people, plan on a December 1st to getting something done by December 31st. Special topic. Just to talk a little bit about fees. We said that the fees for these plans, they are very expensive. Obviously, a 401k, a SEP, you're talking about free or $100 a year or something very, very nominal, simple plan. Of course, when you set those up with a lot of administrators, they typically do not cover the 5,500, which is a form that you have to file with the IRS when your account balance is greater than $250,000. Now that's just for a 401k. A SEP is actually a type of an IRA. You don't have to do a 5,500 for that. But a 401k, again, if it's below $250,000, pretty simple and easy and cost effective. Now, when you step up to a defined benefit plan, you've got a much higher fee structure. For example, our structure, we set up a plan. The plan document itself is $990, but we charge a $250 for a participant fee. And then for each extra participant, we'll charge $150 or so. So, typically our setup is $1,200 to $1,500 or so. And, we can customize the plans a lot more. A 401k is a rather simple, basic form with really not a lot of customizations because, again, your limits are established up front. It's set in stone. Whereas with the defined benefit plan, we can front load a plan. We can set up specific fixed amounts. We can set interest crediting rates that are different. So we have a lot of these different customization variables that needs to be taken care of, and they're much more extensive. So typically you'll see a plan, again, like I said, ours are $1,200 to $1,500. We've seen a lot of other people that do, excuse me, a couple $1,000s a year, a couple $1,000s for setup. I came across someone who was talking to a competitor of ours, not really a direct competitor, but they were going to do it was $8,000 for setup and $11,000 for administration. Now they did have a lot of employees. So I think I quoted him something like $2,500 for setup and $4,000 a year for administration. So again, big range there. We typically, as far as I've seen out there, have one of the lowest fee structures when it comes to setup out there. So You can't get much cheaper than, $1,000 to $1,500. Now on the administration side, we'll do $2,100 for the annual administration. And again, that is a fee that you have to pay every year to the TPA. And you ask, why do you have to pay that? Well, every year there is an actuary that has to sign off on everything in the plan, okay? The actuary actually signs off on what's called a Schedule SB. The Schedule SB is essentially the actuary certifying to the IRS on an IRS form that, yes, these contributions that are being made are legal under the plan. They basically are certifying to your funding to the IRS. Okay, so you're getting, your contributions are essentially getting blessed by us every year. But in addition to that, we've got to do the 5,500 that we file. We do an annual tax planning. We typically do tax planning twice a year with most of our clients. We do a lot of other types of structuring. We get involved in freezing plans, changing, amending, new IRS guidance that are out there. We really hold your hand through the process. And again, for a solo plan, that's $2,100. Each individual person, it's going to run you about $150 or so. So, if you've got a half dozen employees, you could be looking at a few $1,000s a year to administer. Again, just really depends on your situation and the structure. But you will see a variety of fee structures out there. We, I believe, are one of the lowest cost providers out there. You could say typically, you get what you pay for, but I would tell you one of the reasons why in our situation is a little unique is that most people act as administrators. We're born of a CPA firm, so we sort of know how to structure these things. And we're very good at using technology to try to structure these things and make them as efficient for us to save everybody time with e-signature and all these other types of things. So we do everything we can to streamline the process to really make it cheap. So I always tell clients, make sure if you're talking to people, make sure you review the fee structures, because you're going to see a wide variety of folks out there who are charging these plans. I mean, it's not unheard of for people to pay, $10,000 for, a year in annual administration for something that we would do for $3,000 or something like this. So make sure you ask the questions. We have a pricing page on our website. You'll see that if you go to our main site, you can see on the pricing, so you can take a look at that point. You'll get an idea of, some of the pricing, some of the bells and whistles that we have with our plans. And like I said, you could certainly reach out to us and schedule a call with us to discuss that. I see a question just came through. I'm going to hit that here in a quick sec. Again, what do we do? Offer a turnkey solution. We run free plan illustrations. We'll do a free strategy review depending on your income and your contributions, where your income is today versus next year. We do all your IRS filings, 5500s and Department of Labor, and then all your actuary reviews. That is all encompassed. If you have any questions, shoot me an email. You've got a phone number to our site. And actually, if you go to our main site, at the end of this, you're going to be redirected to our contact page. If you go on there and set up a contact form, I always recommend people, rather than getting an illustration request, go ahead and sign up for a 30-minute review with us, because in that 30 minutes, we could say, hey, you're a great candidate, you're not a good candidate, point out those pros and cons and give you some things to think about, okay? That being said, again, I went over some of the basics. I'm going to hit a few questions here. I've seen a couple that have come in. Let me take a look here and I will go through it. All right. I've got one right here. Is the $3.4 million plan max per person for the whole plan? So right now for 2022, it is a 3.1 million. The IRS has recently just come out with guidance for 2023. It's 3.4 million. Every year it goes up a little bit based on indexing and inflation. Obviously, we've had a lot more inflation this year, so it's gone up a bit more. So it's 3.4 million. Now that is the maximum that a individual can have in the plan itself, not for the whole plan, in individual plan. So if you had a husband and wife, let's say you had a husband and wife physician, each one could get $3.4 million into the plan, 6.8 million. Obviously, they have to qualify to have that amount of income. So if they're a high income, that shouldn't be a problem, but it's 3.4 million per person at retirement age. It's typically age 62. If you had 3.4 million in a plan and you were age 50, you'd be substantially overfunded, wouldn't be able to contribute for a while. But again, I think I answered the question. Now, it's kind of a two-parter. Does a 3.4 million include the concurrent 401k plan? No, it does not. The 3.4 million is only for defined benefit plans or cash balance plans. Again, a cash balance plan is a type of defined benefit plan. And so the 3.4 million is limited to that. Your 401k plan, there's no limits. Again, you can contribute to that as much as you like, certainly once you're in excess of that amount. Couple other questions I've got. Do we set up the investment accounts? We, as part of what we do, we work a lot with Fidelity, Vanguard, Schwab. We do not directly set up the accounts for you. If we did that, you know, obviously we'd be chasing down paperwork all the time and so forth. But we can provide you with articles, support. We have an onboarding call where we walk through it all with you, tell you, here's the form you're going to need. Here's who you have to get it to, set it up. You manage your own investments with us. Again, we are not financial advisors, so you're in charge of your own investments. So we do assist you. We also will charge $400 if people want us to set the investment accounts up for them, which we actually do from time to time. Up to you, but most people have the ability to set the plans, their investment accounts up themselves. And got another question. It looks like it says, can you do a sole proprietor with the plan? Absolutely. You can have these plans with any type of entity, partnership, S Corp, C Corp, sole proprietor. The contributions are a little bit more challenging to do when there is a sole proprietor, but you absolutely can for any company, any size. Again, if you're making a marginal amount of sole proprietor, 100 grand, probably doesn't make a lot of sense. Okay. Can you terminate the plan if it's a few years already and $3.4 million is reached? I would say generally no. Well, you certainly could terminate the plan, but you'd have some problems with that. If you terminate an overfunded defined benefit plan, there is a 50% excise tax on the terminated fee. In addition to that, you have the entire excess comes back at reversion and is taxed at federal and state. Bottom line is you lose 90% of it. So let's look at a hypothetical example. Let's say you're 50 years old, you open up a plan, you put $200,000 in, and in the second year you put $200,000 in, and the third year you put $200,000 in, you have 600 grand, let's say it grew to 700, and then let's say you bought the next best stock out there, and your plan went from 600,000 all the way up to 3.4 million, and you're now 55 years old. You say, hey, Paul, I got good news. I'm at 3.4 million. And, I've invested in these great stocks. Well, you want to keep these things conservative, because I would tell you, I got good news and bad news. The good news is it's all tax deferred. The bad news is you would be substantially overfunded. And if you terminated the plan, remember that 3.4 million, you have to essentially earn it, and it's going to be at age 62. So if this happened at age 55, you might have, and I'm just going to make up numbers here. Let's just say $1 million was the most you could have in. So you'd have $2.4 million of excess contributions that you'd be taxed at 90%. Obviously very punitive. The way around that is, I would tell you, guess what? You cannot contribute to the plan anymore, and you have to keep it open until age 62. Now, that would be a little bit of a bummer if you were 54 and you had to wait another 8 years. But again, you got 3.4 million. So it's, it's not the worst situation in the world. But if you're looking at the question, if it's a few years and it gets that large, you're investing in some very risky assets. This plan, you want to have very vanilla, basic assets, and anything that's going to be risky, like that great stock that I said, do that in your IRAs, your 401ks, because again, those are defined contributions. There's no limits on the high end. Okay. So that allows you to, essentially, hit a home run and you don't have to worry about these limits. Okay, so hopefully that made sense. Excuse me here. What is the annual filing requirement aside from the Form 5500 SB? Is there annual regulatory fee requirement? So when the plan is above 250,000, you do have to file a Schedule S. Well, you get an SB every year, which is the actuary certification. We do the 5,500. That's all included in our fee. And as far as an annual regulatory filing fee, there's nothing from the IRS. There's no other fee that the IRS charges. The IRS doesn't charge you, $300 a year just for the sake of doing that. So that's the only fee that covers those other two forms. We do give you a couple other reports, an actuarial evaluation, some other reports, more compliance reports. But the 5,500 and the SB are the only ones, that are filed with the IRS. And again, no other fee with the solo plan. So you only need to file if balance is greater than 250. That is correct. SB has to be obtained every year. You have to have an SB every year. But the cash balance plan does not have to file a 5,500 until the balance in the plan is greater than $250,000, or the balance combined with the 401k is greater than $250,000. So if you set up a plan in year one, you had a 401k from before, you had 100 grand in there, you put 100 grand in this plan, you got 200,000. No 5,500 is needed for either one of them. However, if you have an old 401k, it's got 200 grand. Now you contribute 100 grand in the cash balance plan. You've got 300,000. You have to file 5,500s for both plans. Once the combined balances hit 250, you have to continue to file those two plans. Again, if your old account was a SEP, let's say you had 200,000 in a SEP and you put 100,000 into here, SEP does not have a 5,500 requirement. So you would just be left with 100 grand, no filing requirement. Okay, that's hopefully pretty straightforward, but a lot of people are unaware of those rules. We don't charge extra for them, and we don't give you a discount because most people, to tell you the truth, our average contribution is about 150, 160. Most people come to us already with the 401k in place, so we find that most people were filing 5,500s in year one, if not year one, year two. Hopefully that makes a lot of sense. There were some good questions. At the end of this, you're going to get also a link so that you can listen to a call replay. You can also sign up for another call in the future. You're more than welcome to. Also sign up for a call. We're glad to kind of review everything with you and do a custom plan for you. We hope you learned something, and hopefully we'll be talking to you again soon. Have a great day. Bye-bye.